听见资本，本期视频为您带来的是摩根大通在3月27日录制的有关关税、债券发行和财政驱动因素话题的内容。4月2日的关税公告即将来袭，欧洲利率市场已经感受到压力。摩根大通的专家预测，这会让市场焦点从财政政策转向关税，短期内可能推高波动。德国10年期国债收益率现在是275个基点，他们预计到2025年会慢慢降到240到250个基点。投资者的掂量下这个长期趋势。欧元区利差和 SSA 债券呢，现在估值偏贵，又碰上关税风险，专家提醒要小心，别一头扎进去。新的重整欧洲，2000内30准备计划推出了 SAFE 工具，想推高国防开支，但短期内对欧盟债券发行的影响有限，别指望市场马上有大反应。德国这边财政扩张可能会让债券发行量涨个450到650亿欧元，但啥时候落实还不确定，投资者得盯着点。挪威和瑞典的利率政策也在拖后腿，降息推到年底，国防开支增加可能让通胀更黏糊糊，市场别太乐观。英国刚出了春季财政报告，财政紧缩力度不大，市场反应平淡，但专家警告，增长预测可能太理想化了，风险还在后面。总之，关税、财政和央行动作交织在一起，欧洲利率市场暗流涌动。接下来是英文会议的全部内容，如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hi, and welcome to At Any Rate, JP Morgan's global research podcast series, where I take a look at some of the drivers behind the biggest trends and themes across fixed income, currency, and commodity markets. I'm Francis Diamond, head of European Rate Strategy at JP Morgan, and today I'm joined by my colleagues Aditya Chordia and Kikendra Gupta to discuss our current views on European rate markets, reflecting on what happens to European rates ahead of the 2nd of April tariff announcements, some thoughts on SSAs and issuance, Scandi rates following the recent ECB meetings, and UK rates in light of this week's spring statement. So DM yields have been buffeted by a range of different macro drivers over the past few weeks, with euro yields reflecting the seismic fiscal shift from a few weeks ago in Germany, US dollar rates reflecting weaker data, increased downside growth risks from tariff, whilst front-end GBP yields have range traded on a combination of macro and technical drivers. But tariffs are definitely back in focus, though, following the announcement this week of a 25% tariff on US auto imports and the expected announcement next week on reciprocal tariffs on the 2nd of April. We're recording this podcast on 28th of March, and our comments today are based on published research available on JP Morgan Markets. So, Aditya, let's start with euro rate markets and your thoughts on German yields and intra-EMU spreads ahead of the 2nd of April tariff announcement.
Sure, Francis. As we have been talking about in the past couple of weeks in our publications, increased fiscal spending may take some time to be implemented in Germany, and similarly, the higher defense spending will most likely be a more gradual story for the rest of Europe, and hence, over the near term, we expect the focus for euro rate markets to shift away from longer-term fiscal drivers back towards tariffs. And indeed, the sharp rally in German yields post the US announcement of auto tariffs earlier this week supports this thinking. We remain comfortable with our strategic bullish duration biases, and we continue to expect 10-year German yields to decline gradually over 2025 and settle around, let's say, 240, 250 basis point level versus current levels of around 275 or so. We therefore still find current euro rate levels quite attractive for investors with more medium-term strategic horizons. On a tactical basis, we have been expressing our overweight duration stance via, let's say, low beta proxies or conditional trades going into the 2nd April tariff announcement, given the uncertainty around it. Moving to intra-EMU and SSA spreads, we have been running a cautious stance given the expensive valuations of the spreads after recent tightening, upcoming tariff event risk, and the position technicals. Overall, the recent limited reaction or even modest tightening we have seen in intra-EMU spreads, despite the increasing tariff uncertainty, has been quite surprising to us. In the way, in our view, it could either be due to a view that bad tariff news is already in price and hence will have a limited macro sentiment effect once implemented, or given the amount of conflicting headlines on tariffs so far, I think the market is just saying we just wait for actual delivery before reacting to it. Is it the former or the latter? I think it's still up for debate. But either way, we believe that given the expensive valuations and the positioning which is on the overweight side, underweight intra-EMU and SSA stance going into the tariff week makes all sense to us.
Okay, that's pretty clear in terms of the market views, but let's switch gears a bit to SSA space, and particularly the announcement of the ReArm Europe Readiness 2030 plan. You recently published your latest SSA monthly update. Perhaps you could outline how you think this plan, and particularly the new safe instrument, could potentially impact SSA issuance going forward.
So there has been a very increased focus on, let's say, stepping up the defense spending across Europe at country level and also at the European level. And in a substantial shift on fiscal policy, the EU announced the ReArm Europe or Readiness 2030 plan around in a week or so back, where it was in order to ramp up the defense spending, and which includes a 150 billion EU level loan facility called SAFE, up to 650 billion increase in defense spending delivered at country level via the activation of national escape clauses in the budgets, repurposing of existing EU budget instruments like cohesion funds, support from EIB, for instance, via expanding its mandate to provide private sector loans, and also mobilization of private capital. So they are approaching it from all different angles. The 150 billion SAFE initiative uptake, in our view, is subject to, the way they have structured it is subjected to lots of conditions like joint procurement, sourcing of procurement from, let's say, a large part has to come from specific European industry sectors, etc. Also, at the same time, there is the typical approval and tracking process with the EU for such loans. So the uptake of these loans, in our view, will therefore likely be made only in case if it makes sense in terms of cost-benefit analysis for the countries. So it's not going to be used by pretty much every country, but I think it could be used for countries where the cost of funding is beneficial or some synergies can be found for joint procurements. Also, at the same time, in those announcements, the EU has indicated that despite the introduction of SAFE, the EU as an issuer, its funding needs for first half of 2025 will remain unchanged. Moreover, they also highlighted that the changes in bond issuance arriving from the SAFE program will likely be limited in 2025 and 2026 thanks to their unified funding approach. So effectively, the way I read that is that there will be a limited impact from eventual SAFE funding needs on the 2025-2026 EU bond issuance target, which is roughly around 150-160 billion. So therefore, very limited impact on EU issuance near term. Also, based on our calculations post 2026, we believe that around 20 to 50 billion per year can be funded via EU in order to provide, let's say, funding for the SAFE program, as well as for any potential Ukraine reconstruction or budget needs after an, let's say, eventual peace deal. Currently, the EU issuance is expected to decline sharply after 2026 as the new NGU program as all new NGU funding will stop beyond that. So adding 20 to 50 billion of extra issuance on top of, let's say, the rolling redemptions will not be a big concern for the market. On the margin, I believe it will be a positive development for EU, as it will keep EU as an active large issuer over the medium term, further helping in the journey to become a Gavi-like issuer with further improvement in liquidity. So net, I think limited near-term EU supply and the medium-term, a positive spin to it.
Okay, so that's pretty clear in terms of not really expecting a big impact for 2025, and it's really more a 2026 story. But let's stick with the issuance theme here. And have you got any thoughts on the implications, let's say, for Germany, particularly in terms of sovereign issuance over the rest of this year in light of the fiscal shift that was announced a few weeks ago?
So based on the German fiscal estimates done by our economists, once looking into the fiscal package, the big fiscal package which Germany announced, we believe the deficit of this year in case of Germany will increase, let's say, from around 2.4%, which is currently the 2024 deficit, can go somewhere around 3 to 3.5 range. So around 1% or so higher. And then it will eventually settle around 4% from 2026 onwards, assuming a full execution of the fiscal package. The 1% increase, in our view, could lead to around 45 to 65 billion of higher, let's say, bond plus bill issuance needs to be executed during the second half of this year. However, like we just published our issuance outlook also for the second quarter, and we only made an incremental change of 25 billion increase to our 2025 German issuance. And that is because we still believe there is a high degree of uncertainty on the execution and timing, especially for 2025, like when actually the execution starts. If it gets delayed for a few more months, then the actual delivery might be less than the 45-65 billion we think in the base case. So therefore, we are making that incremental change, and we'll be revisiting it around mid-year when we will have more clarity on the new government and its budget plans. At the same time, outside Germany, we expect limited impact to 2025 issuance forecast, as we expect gradual defense spending build up to happen over coming years. Like I'm thinking more about like couple of tenths, like 2/10, 3/10 of GDP increase in defense spending on average per country over the coming years. So those are very small numbers and can easily be digested in the existing plans, or let's say increasing non-conventional issuances like retail or T-bills. So for me, I don't believe there would be significant changes to my, let's say, non-German issuance plans. And for the Germany, I think I'm just happy to make some incremental changes and wait for more detail.
Okay, great. A lot to think about there in terms of issuance. So let's focus a bit more on a different area, Kigenda and Scandi. So this week we saw the Norges Bank keep rates on hold, having previously guided towards some form of easing. We saw Sweden announce a large package of defence spending. So do either of these two materially affect your views on Scandi rates?
Hi, Francis. Yes, contrary to their prior guidance, the Norges Bank held rates constant, which is actually very different from historically what they have told us, and delivered in line with that. In any case, they are yet to start their easing cycle and remain, in our view, strongly on hold at the current rate of 4.5%. The recent uptick in inflation and the strength of the regional network survey were the primary reasons, in my mind, behind them staying on hold. We had originally anticipated them to start easing this week, but then had removed the March cut after the regional network survey last week. In our view, inflation is likely to remain sticky over the coming months and only decline very slowly. So we now expect them to start easing only in December, which is when the core inflation declines below 3% this year after rising sharply over the last few months. Now, we have used this 3% as a soft marker for them to start the easing cycle, and hence the delay until December, even though their own guidance is for rates to be cut twice this year, whereas market is pricing somewhere around 1.5 cuts over the course of the year, which we think is broadly fair. I think risks are biased towards them delivering more cuts relative to our forecast of one cut, especially if the U.S. tariffs lead to a sharp decline in euro area and global activity. We do not expect Norway to follow the route of Europe in increasing issuance, given the availability from the sovereign wealth fund in terms of scope of spending. On Sweden, the Riksbank also stayed on hold last week, but that was widely expected after the large jump in core inflation earlier this year, even though this was largely due to the basket effects and the temporary rise in food prices. This level shift in inflation, along with the backdrop of improving macro conditions and labor market, we expect them to stay on hold over the forecast horizon. In line with Norges Bank and the ECB, we believe that risks are biased asymmetrically dovish, and they can deliver further cuts if macro worsens further. You mentioned about the defense spending announcement. I would say that this is along our expected lines. It does raise the bar for further Riksbank easing, given a positive impact on growth and inflation. We also believe that this is broadly supportive of further expected underperformance of STIBOR rates versus Euribor, a theme we have been pursuing over the past few months and has worked reasonably well until now. This additional issuance will likely, in my view, keep swap spreads narrow and maybe bias it further narrower, as spreads have been remarkably stable over the past few months, especially considering that German swap spreads have narrowed more than 20 basis points over this period. Anyway, overall, we like to fade any hikes that gets priced in the money market sector for the 2025 sector. but expects LIBOR underperformance further out the curve, especially versus Euribor.
Okay, thanks. You touched a bit on German swap spreads there, and the trend, the German swap spreads have been narrowing over the past few months, and then we got the German fiscal announcement driving another leg narrower. How do you interpret the moves we've seen more recently in German swap spreads?
Yeah, German swap spreads narrowed sharply on the fiscal announcement earlier this month. Like Bund spreads narrowed about 6-7 basis points. Schatz had narrowed about 3-4 basis points, but then Schatz had retraced relatively quickly, whereas Bund has been retracing rather slowly. Now the retracement has picked up pace over the last few days as market concerns have moved on from fiscal towards tariffs. We were expecting some retracement post the moves. As we discussed previously in our research, our models had suggested that these moves that we saw post announcement were consistent only with market expecting hundreds of billions of issuance over a relatively short period of time, which we thought was too aggressive at that time. In addition to fading these extreme moves post announcement, as I mentioned, recent risk-off sentiment has also driven some further retracement in spreads. I want to highlight that historically, Schatz swap spreads have been a good proxy for risk-off moves. However, this time around, we believe that Bund spreads or spread wideners probably offer attractive risk-reward on any risk-off move, especially as we go into next week, a tariff announcement. For example, Schatz spreads are trading fair in our model and are also towards the upper end of its last 6-month range. And more importantly, they do not really show a strong relationship versus typical risk-off metrics over the last few months. In contrast, Bund spreads are still flashing cheap in our fair value analysis. They continue to exhibit a strong negative directionality versus yields, meaning they're expected to widen in a rally. Francis, let me switch the focus to the UK markets, where the focus was primarily on the spring statement this week. So how do you think this was received by the market?
Yeah, so I think overall, the combination of fiscal tightening measures and forecast revisions delivered in the spring statement were not a massive surprise. It appeared to be taken with some relative credibility in terms of market term premia, in our view. And in terms of details, maybe it's a slightly smaller 10 billion fiscal tightening was announced than we had expected. And the details, I mean, it's going to be correcting this 14 billion deterioration in the public finances, which come from the growth undershoots and obviously high yields since the last budget. And that basically means, as a result, the fiscal headroom is now restored back to the relatively small headroom of 10 billion over the forecast horizon. Just look at the details there again, probably in line with expectations. So the 14 billion adjustment has roughly 4.8 billion of welfare cuts and reforms, 3.5 billion of cuts to departmental spending, and around 1 to 2 billion additional contribution from tax avoidance measures, and then some modest forecast fiscal tightening over future years from a boost to growth from planning reforms. So in terms of market movements, I mean, actually 10-year and 30-year gilt yields were lower on the day of the spring statement. So clearly sort of taken with some degree of relief in terms of markets, but then we've seen some choppy market moves over the last couple of days, resulting some technical dynamics at the long end of the curve and a bit of a risk-off driven rally on the back end of this week. But I think bigger picture, fiscal issues do remain. There's still a bit of a lingering can-kicking approach to the medium-term fiscal dynamics. The OBR revised down the 2025 growth forecast by more than expected, which makes sense to us. But future years, you still see some upward revisions to growth, which now look even higher and more overly optimistic than the forecasts from the last budget in October. So I think our sense here is term premium, the curve probably just stays relatively elevated, although maybe 30-year rates could move a bit lower, given in outright terms the level of yields is quite high. And I think if there is a US announcement on the 2nd of April of wider and broader based reciprocal tariffs, that probably puts some downside bias to growth risks, which probably manifest in lower yields in the UK to some degree. So that's it from us. Thank you for listening. Stay tuned for more updates on the fixed income space here on At Any Rates, JP Morgan's Global Research podcast series. This communication is provided for informational purposes only. Please read the JP Morgan research reports related to its contents for more information, including important disclosures. Copyright 2025, JP Morgan Chase & Co. All rights reserved. This episode was recorded on 28th of March 2025.